I heard the new term that now we're switching to agent as a service rather than software as a service. Has that played out yet, or is it still in the early stages?
AI is going to have so many impacts in VC, both from the perspective of the companies we look to finance, but also from the VC's day-to-day job. In addition to asking the classic VC questions to find a case attractive, we need to add this kind of lens of what is the risk of disruption. Climate tech is just referring to the companies that specifically address climate or environmental impact. But climate is incredibly broad and spans a lot of different sectors. We spent a lot of time looking at the building space. Buildings account for 40% of greenhouse gas emissions in the EU. We've looked at a lot of ways to optimize the energy consumption of buildings. In the mobility space, transport's one of our highest emitting sectors as well. So finding ways to make that more green and lower the carbon footprint. Ag tech, food tech, materials and consumption, recycling, the list goes on and on.
And I love that you're sharing this because some people think that it's just electric vehicles, but there's a lot more to it than that. Hello and welcome to the Investing and Other Stories podcast. I'm your host, Margarita Tr, a former Wall Street executive, CFA charter holder, and the founder of Finance Latte, a leading investing education company. I founded this podcast to fill what I was missing in the finance industry, a place where top women investors can share insights directly with individual investors to empower them and inspire them to invest more and build wealth. It doesn't matter if you have been investing in stocks, funds, and startups for years or you're just getting started. This podcast is for you. The content provided on this podcast is for informational purposes only. It should not be considered investment advice. Stay tuned at the end of this episode for more important disclosures. I'm so excited about today's episode, not only because it's our second recording here in Stockholm, but also because of our fantastic guest from the venture capital world, Chloe Fu. Chloe is an impact VC based here in Stockholm. Most recently, she worked as an investment manager at Trill Impact Ventures, where she invested in early-stage climate tech startups across Europe. Prior to her work on the ventures team, Chloe worked on majority acquisitions of late-stage companies as part of Trill's Impact private equity buyout team and in the M&A team at KPMG. Before moving to Sweden, Chloe's experience spanned non-profit work, impact-first investing, and early-stage impact venture capital in Canada and the US. Chloe, what a global and multi-dimensional career. I'm so excited to have you here, and a warm welcome to our podcast.
Thank you so much. So happy to be here.
Wonderful. You have such an inspiring career, moving from the nonprofit sector to venture capital. I'm just really curious, was there a moment in your life where you said, okay, I need to take this next path and enter the finance and venture capital industry? And once you realized that, what was your career journey to enter the finance field?
Yeah. I'm originally from Washington, D.C., and I really grew up with impact as a core value and became heavily involved with the Red Cross, working a lot with blood drives and engaging youth in those in high school and also in university. And then I went to Vancouver to study at University of British Columbia, where I got a finance degree. And during that time, I was running a nonprofit organization, which was raising money for local charities. And I quickly realized that charities are some of the most impactful organizations in the world, but are unfortunately incredibly dependent on donors just to continue to exist. And then in my degree, I learned about the concept of social enterprise, which was finding a way to build a business model around an impactful outcome so that organization could actually make their own profits, continue to sustain themselves, and actually scale that impact. And I thought, what an effective model. I need to work with this. And in conjunction with understanding social enterprise, I understood that impact investors were the ones actually financing that. So I knew certainly that's what I wanted to do with my career. So in my final year of university, I was part of the first cohort of a student-run impact fund. We made impact-first investments, so we prioritized the impact outcomes rather than making a financial return. That actually went very well. They've been able to also make a financial return, and that scaled across every major Canadian university under the name Propel Impact. And that totally solidified things for me. So I graduated. I went to work for Renewal Funds, which was at the time one of the largest early-stage impact VCs in North America. And they were also looking for profit in tandem with impact. So I did that for a year, and then my Canadian visa was coming to an end. And the question was, where do I want to launch my career in sustainable finance and impactful finance? And in 2018, the US was really looking at impact investing as philanthropy or charity, and it was so far from mainstream. And then I looked towards the Nordics, and it was such a sophisticated, mature ecosystem. So I ended up doing a bunch of research and coffee chats and networking, and ultimately made the move to Stockholm in 2019, first by joining KPMG's M&A team, or mergers and acquisition team. That's where I got my first experience in private equity and in finance, and in networking, I came across Trill Impact. And Trill is a fairly new impact investing firm. It was started by Jan Stolberg, who was one of the founders of EQT back in 1995.
Oh, okay.
Exactly.
I did not know that. Okay.
And he helped build that organization into the massive manager that it is today. And he left his role as deputy CEO and vice chairman in 2018 to start Trill with the ambition to create another investment firm that has all different types of investment areas, but with impact at the core of each. So I joined him at the very beginning. I think there were 5 of us on the investment team, where I was the 5th. And we went out to raise our first fund, which was a mid-market private equity fund. We raised 900 million euros. Concurrently, we also launched a microfinance fund as a completely separate type of impact investing strategy. And then about 3 years ago, we launched a venture capital fund. So I spent my first 2 years on the PE side. And then when we launched the VC side, I was very eager to go back to the early stage side of things. And so that's where I went after. And it's been fantastic. Really certain that this is what I want to do with my career. I've also just recently made the decision to leave Trill and move on to a new exciting chapter, but still in impact VCs. Yeah, that will be announced in the coming weeks.
Wonderful. I know one of the things that I always go back to, especially when I talk to the younger generation, is grab those coffees, network, ask questions. It doesn't matter if somebody's hiring or not. Just network your way into your dream job and you can do it. So I'm really glad to hear that was your way in, not a far uncle somewhere who made the introduction, because a lot of us don't have that uncle.
I am evidence that the brute force networking does work. Yeah,
I love it. There were a lot of terms in that journey that I think some of our listeners might not understand. Venture capital, private equity, buyout. Can you just give us a brief primer on the differences between all of these terms?
Yeah. Private equity just broadly refers to investing in private companies. So that in contrast to the public equity world where you're investing in listed companies on the stock exchange. Within that world of private investments, it scales from the kind of very early stage startup side of things, which is where venture capital or VC is, to the very mature private businesses that have been around for a while, are much larger, maybe even profitable. And that's where the private equity or PE term is used. The kind of differences are really in the VC side. You're making smaller sized investments in smaller companies. And if you think of ownership like a pie chart, you're just buying a slice. When you look at the private equity side of things or buyout, that refers to a much larger pie, it's a larger company, and actually buying out the majority ownership of that business. So at least 50% of the pie, sometimes the entire pie, so that you have full control of that business. And then I guess in both cases, the hope is that during your ownership period or during your investment period, that the pie grows so that when you exit or sell the company, that your slice or your piece of the pie has also grown and you're able to make a profit off of that.
Exactly. Lovely. I love the pie example. That's very visual, and I think a lot of people can fully understand that. And just one more note, on the private equity side, you get a lot more involved with the company, especially if you buy the entire business.
Yeah. It is a control aspect. So you are actually in charge of the strategy and where that company goes. But often you're buying the business, you're relying on the management team that's taken it up to that point to continue that growth journey, but you have much more hands-on involvement. If you'll indulge me, I love giving this kind of comparison as well so that it adds more like concreteness to what it means day to day. And I always talk about deal making in private equity as more of a science, whereas deal making in VC as more of an art. And the reason for that is because in private equity, you are looking into companies that have been around for a long time in markets that are super well established. There's decades of years of data that you can look through to make this investment decision. But usually it's under a really fast time frame and a really competitive process. And so you have just a very short period of time to learn as much as you possibly can so that you can ultimately make a very informed decision and offer a price that you think will win the bid. And so in that case, the kind of limiting constraint is time. And to be a good PE deal maker, you just need to be incredibly efficient and productive. In the VC side of things, these are companies that just began to exist. There's very little historical traction to analyze, sometimes none. Sometimes this market just was invented yesterday kind of thing. There's an actual finite number of experts out there that you can speak to form an opinion on it. And so in this situation, The limiting constraint is really information. And then in order to become a good deal maker in VC, it's about how do I make the smartest decision that I can with given limited information. It becomes a little bit more intuitive and a skill that you craft over time. So hopefully that adds a little more.
I love that comparison. Yes, I think it's so true. You have all the data on public equity and private equity at a later stage, but you can look at a startup that has no revenue at all, no traction. So yes, how do you invest in that? That's more of an art for sure. Okay, so let's go back to venture capital. Give us a sneak peek into your day-to-day. What does it look like? What do you do day-to-day?
Yeah, so it's basically my job to go out there, find really great companies that I believe in and build a relationship with them. And at the same time, try to learn as much as I can so that when they go out to raise money, they'll choose us as an investor. We make a lot of deals every year. And so you have to be managing multiple different work streams at a time. In a busy week, my team might receive like 50, 60, even 70 pitch decks for different companies in completely different sectors. And so I can go into work in the morning and start my day trying to understand what do I need to know about an attractive company in ag tech or agricultural tech. And then I can move on to lunchtime and say, okay, now I'm really deep diving on EV battery recycling. And then in the evening, I'm looking into food tech or space tech. It's such a dynamic type of job. And it's really just about learning as much as you can, always being hungry to learn more, building on the knowledge that you've created. But yeah, it's a really great thing. You get to meet a lot of other very smart investors, some really passionate founders. I think it's great.
It definitely sounds intellectual stimulating. And just from your body language, I can tell it is. But a lot of times, especially when we're talking to younger women, oh, it's such a bro culture. I might not fit in. And I love that our podcast can bring people like you as an example. And here is a successful venture capitalist who really enjoys it and thinks it's fun, intellectually stimulating, etc., etc. So thank you for sharing that. So while you were at Trill, you focused on climate tech. Can you define a little bit more climate tech versus green tech versus impact?
Yeah, so impact just refers broadly to any company that's creating a positive impact. That can be environmental, that can be social. So it's super broad. Climate tech is just referring to the companies that specifically address climate or environmental impact. So where a broader impact investing firm would also look at investments in, for example, health or even like cybersecurity or education or poverty alleviation, we focus solely just on the climate side of things. Mm-hmm. And in that way, it can be a little bit more specialized. But climate is also still incredibly broad and spans a lot of different sectors.
Can you give us some examples within that?
Yeah. So Trill overall, we spent a lot of time looking at the building space. Buildings account for 40% of greenhouse gas emissions in the EU. We've looked at a lot of ways to optimize the energy consumption of buildings. The mobility space, transport's one of our highest emitting sectors as well. So finding ways to make that more green and lower the carbon footprint. I mentioned ag tech before, food tech, materials and consumption, recycling, the list goes on and on.
And I love that you're sharing this because some people think that it's just electric vehicles, but there's a lot more to it than that. So is it time now to get an example of an investment that you've made in the space and that you're really excited to see grow?
Yeah, the last case that I got to work on was a Belgian regenerative agriculture startup called Soil Capital. And what they're doing is helping farmers kind of transition from conventional farming practices, which can actually be really detrimental to our land, and move towards more regenerative practices. An example of that is like reducing the amount of tillage that a farmer uses that actually rips up the dirt and destroys the soil quality, or otherwise reducing the amount of chemicals that the farmer uses. And over time, using these regenerative practices actually improves the yields for farmers, and it also reduces their operational costs. But the benefit to the environment is that as the soil health improves with regenerative practices, soil is actually able to sequester more carbon from the atmosphere and act as a greater carbon sink. And they found this really smart way of turning that into a business model and financially incentivizing farmers to do that by issuing carbon credits for every additional ton of carbon that they're able to sequester. When those credits are issued, they are then able to sell those to buyers. And in this case, they're just selling through insetting, which is selling to companies in the food sector like Nestle, Cargill, Danone, who all want to reduce their own Scope 3 emissions or supply chain emissions and are actually able to buy those credits directly from their own farmers. And the best thing about this is also just what this does for the broader food ecosystem. As the quality of our land is degraded, it actually threatens our food security. And by using regenerative practices, it makes land so much more resilient to climate change like drought and flooding. And so by doing this, it's actually also improving the global food supply chain and security for the future.
That sounds quite fascinating. And what was the name again?
Soil Capital.
Okay, thank you for sharing. So I want to talk about trends. What are the key trends within Greentech that you see for 2025?
It's been a very tumultuous time. I think that VC has never had a greater extent of unpredictability, and that makes our sector very difficult. But it also poses a lot of opportunities for good deal making. In a time when climate is becoming a less prevalent topic, let's say, in a geopolitical sense, I'm still super confident that there are plenty of very impactful investments to find. I think the biggest theme for me, at least in 2025, though, is going to be risk of disruption. When we are looking for sectors to invest in, we need to see that there is some clear, significant, and unmet need or problem that needs to be solved. And there's not yet a solution out there fixing it. And that this will be a problem that will continue to exist for the foreseeable future. And we look at things like wildfires in California or the flooding in Spain, and there's a lot of other impact sectors, like the cost of cybercrime is growing. These are problems which will only get worse, and we need to solve them. And then you have to apply this kind of other lens of what are themes where all incentives are aligned? Is there a financial incentive to actually solve this problem? Is there a political agenda alignment that will also support the development of a sector? And that's where you can list, for example, like the world is trying to work on their own energy independence from Russia. Increasingly, we're trying to get independence from Chinese supply chains. So anything that helps improve domestic kind of production and manufacturing is also very important. So I think we have to find unique ways to find attractive sectors. And then in addition to asking the classic VC questions to find a case attractive, we need to add this kind of lens of what is the risk of disruption. We've seen AI already able to displace a lot of existing business models. Companies that have spent 10, 15, 20 years trying to build a platform and a tool, which AI was able to do better and faster and cheaper yesterday. And so we need to avoid cases where that company could cease to exist because AI could do it better. I think another element is Chinese competition. We've seen with Northvolt, for example, China come along and find a way to develop lithium batteries in a much cheaper, scalable way. And that totally disrupted Northvolt's success. I think that there's so much more now that we need to be aware of from a regulatory perspective, from a geopolitical perspective, and from a technological perspective. So we really have to add that additional lens of disruption when we're looking for cases. But at the same time, the deal environment should be looking better than it has over the past few years. We're finally seeing the macro conditions that we need to have a more attractive exit environment with reducing interest rates and inflation. We should be seeing more IPOs. And as exits happen and more money is returned to investors, they're able to actually put more money back into the ecosystem, more deal making. And so that should really improve.
Wonderful. Can you give us an example of an impact company using AI to grow and scale?
Yeah, another one of the companies that I worked on when I was at Trill is actually a space tech company based out of the UK, which is called OpenCosmos. And what they're doing is manufacturing small satellites, which go and capture Earth observation imagery, and then combine that imagery with other data sets in order to have certain insights or analytics. And it's done that just to be applied in very impactful applications. One example is that they're able to use data to identify oil and gas leak detection in waterways. Another is just by monitoring forestry or deforestation in this sector in general. There's so many use cases. It's even with natural disaster kind of response, with wildfires, for example. What you can actually do is capture the imagery of what's going on and how quickly the wildfire is spreading. Take historical wildfire data and be able to say, this is how quickly it will spread. These are the areas it's likely to spread to in this amount of time. And then you're able to actually have as an output, these are the evacuation routes that people should take at each minute as it progresses. And these are the routes that first responders need to take to get in and safely get out. And so that is, I think, a really powerful application of AI for an impact cause.
Absolutely. And do you know if they used that technology in the recent Los Angeles fires?
Not OpenCosmos in particular, but it has been a heavy element of the recent California fires.
And you mentioned before the risk of disruption. Are there any green tech specific areas where those companies are going to be disrupted even more by AI, you think?
Yeah, and I want to tread lightly because I don't want to insult any of my VC friends who have made investments in these areas. I think right now, everyone that has invested in very niche or vertical specialized SaaS or software as a service companies, I mentioned earlier, there's this risk that AI can come along and do it better tomorrow. And there are some sectors where I don't see why AI shouldn't be able to do what otherwise an actual team of people is doing manually as a service provider to companies, like, for example, climate reporting or supply chain reporting. I think that's just one example of a specialized kind of SaaS tool where AI will come along and do it better. But that doesn't just apply to climate tech. This applies to all kind of SaaS solutions. So it is a very disruptive element.
Great. And I heard the new term that now we're switching to agent as a service rather than software as a service. Has that played out yet, or is it still in the early stages?
It depends which sector you're looking at. Some tools are more advanced than others. So maybe we can make this a concrete example. I think AI is going to have so many impacts in VC, both from the perspective of the companies we look to finance, but also from the VC's day-to-day job. But when I'm looking at startups that in the past have had to raise a ton of money in order to scale their team, to develop their product, and grow, there's also a lot of cost-saving opportunities here where a company might actually be able to come along and just use AI to, one, build the actual product platform. That could be an app, that could be a website. And then two, they don't need to hire the team to do that development. Now there are AI products that actually do your customer service call center management for you. There are AI tools that can do sales prospecting for you. And that really eliminates the need for as many FTEs or people on your team that would have historically been required to grow. And so I think that can actually be a really big scaling and enabling lever for startups to do more with less capital. At the same time, AI really accelerates development. I think startups will be able to grow faster than they ever have. I think they'll also fail faster than they ever have. So it'll be a really dynamic time. But I think that will also just affect the VC industry. If startups need less money, then. And then there's also talk about, can you see a totally AI-run fund in the future? And I'm like, not anytime soon. But yeah, absolutely. That could be a reality in like the next 5 to 10 years. We could see that actually starting to pick up some traction. I still think VC is a heavily people-run business. So I think you can't completely remove the human element, but it's revolutionizing everything.
Exactly. It's possible. And on the public side, I've heard a lot of investors that are really hesitant to even launch a product like that because it's so heavily regulated. But of course, they are using AI to make themselves more efficient, smarter, bring more data, etc.
Actually, on that note as well, I think this is another kind of existential question for VCs and especially junior VCs. We've already seen this in the legal world where AI tools are being applied for legal purposes that are able to actually do a better job than an intern or an associate. And that's insane. Yes, it improves the entire legal workflow, which is fantastic. It improves efficiency. But at the same time, our talent in the legal world, our talent in the VC world was developed by the years of going through hundreds and hundreds, thousands of pitch decks. And that is really how I've honed my ability to pick out a good deal and work quickly. And without that manual experience, how are we going to develop our young talent in the way that we've been able to develop? And so I think that actually is a question that we need to figure out. How are we going to be able to support juniors into becoming really great VCs?
Any thoughts as to how?
I think it's just going to be having the right mentors and teachers that involve you in every step of the way and really teach you the ways to do it and help you or give you the platform to build your own intuition and experience. But yeah, if you have a tool that can do it better and quicker, it means you do have to go a little bit out of your way to do that. But it's important.
So you've touched a little bit on this already about the Swedish startup ecosystem, but I wanted to bring up that before I moved here a couple of years ago, I moved from New York to Stockholm. I had heard that Sweden has more billionaires per capita than even Silicon Valley, but I didn't really understand the vibrancy of the ecosystem until I got here. And it's really fascinating to me to witness it. Can you compare the two sides for us as well, since you worked in the US as well?
Yeah, I love that whole stat. More unicorns per capita than Silicon Valley makes me so proud. I think Sweden has this very unique kind of like attitude of collectivism and contributing to society in a way which is better for the collective good. And I think as a result, a lot of people feel inclined to create something which will benefit society. And also, I think given it's such a healthy economic society, it also means that people are given more tools or There isn't this huge wealth discrepancy like in the US. Anyone born in Sweden is given tremendous opportunity. And I think that's like a big reason we've been able to see an outsized number of large successful startups come out of Sweden. We have Spotify. We have Klarna. Klarna should be a fantastic IPO in the coming year. We have Northvolt, which has gone through a different kind of development, but the amount of innovation coming out of the city is great. I think it's what makes it such a good ecosystem for finding deals and a really cool kind of founder, startup, VC community of people.
And all the Nordics, not just Sweden, are leaders in the Greentech space, right? And is that mostly cultural, would you say?
Yeah, I think so. There's a couple different elements, but definitely. I think I read that the Nordics are one of the most impact-focused regions of the world when it comes to funding. Like almost 40% of VC funding went to impact companies in the Nordics versus 22% for Europe overall and 10% for US and Asia. It's a very impact-minded society. I think a big element of that is just the kind of consumer sentiment. Children are raised with a deep connection to nature. They're educated about climate change and the disasters that causes. That is what inclines them to act and do something about it. I think that the policy reflects that. I mean, there's also a ton of funding that goes towards innovation in Sweden. And a lot of that is targeted at energy, food, any type of environmental innovation. So I came here to learn from the best. It's been a really successful area for climate.
I just want to add that what you were saying about the kids being raised with an attachment to nature. I have a 3.5-year-old, and there are those days where it's pouring rain and they're still outside for hours playing in the rain. I spend most of my adult life in the US, seeing that it's a little bit of a cultural shock, but I do understand it because it has made him, no matter what the weather, he wants to be out, he wants to play out, and that really forms a different connection with nature and the respect he has for his environment. So I can definitely attest to that.
And it's like a remarkable thing when you consider how bad the weather is in Sweden that kids are still that happy to be outside.
They do not mind it at all.
They know nothing else. That's the issue. We do.
Exactly. It works. All right. So let's talk about your investment process. What are some of the investment criteria that you look at to evaluate whether a deal is attractive or not?
So when I'm looking at a deal, I need to make sure that all of the boxes are checked in 3 different areas. And that is the market, the company, and the VC economics. So when we need to find a market attractive, I ask the question, is there some significant, clear, unsolved problem where the demand for a solution will continue to sustain for the foreseeable future? For example, we've been talking about the wildfires in California, which are devastating. There is still no solution to solving that or totally preventing that. Even technology to respond to it more effectively would be really helpful and will be in demand. In contrast, I would not look at a DVD manufacturer and say, oh, this is going to be the market to take off and continue to exist. It's totally obsolete. So we spend a lot of time just understanding the market in general. On the company side, that's where we need to see that the company's offering, either product or service, is effectively and uniquely solving that problem. Is somebody willing to also pay for that solution? And on the unique side, is there some unique selling proposition or USP that is making this offering perform better than existing alternatives or substitutes? And we also need to see that it's not easily replicable by someone else. Another company couldn't come along and do exactly as they're doing. So we call that a defensible moat. Or some high barriers to entry that would prevent another company coming along and doing the same thing. Then, of course, in VC, the team is a huge aspect. You have to believe that these are the people that are supposed to be solving this problem and will be able to scale it. Then enter the VC economics. At the end of the day, if we want to find ways to solve really significant challenges in the world, we need to make sure that they are profitable so that we can attract more money to this ecosystem and continue to support companies doing good things. So for a VC, we need to generally at least 3x our money. So on average, across all of our investments, we should have at least 3 times by the end of the fund or end of our exits. For me, as more of a Series A investor, I think coming in at this point in the company's stage where there is some commercial traction, the product is already made, the team is in place, it's just about scaling now. Usually valuations are at like a reasonable level where it's not insane for me to imagine 3xing it. But there are other types of investing where this is going to be a company that's going to require hundreds of millions of euros. And those become riskier cases. The VC economics is definitely a very important aspect of each case as well.
And what you described is more for Series A, and we can go over some of the definitions, right? Like the different stages. Maybe you can help us demystify those.
Sure, yes. In the VC side, startups range from like angel pre-seed stage to Series A, B, C, etc. And then they enter growth and ultimately the maturity where buyout comes in or where they can IPO. At the pre-seed stage, this could be a founder with a PowerPoint deck with an idea, but no team, no feasible product yet, just an idea who's looking for some pre-seed or angel funding, and that's usually quite small rounds. Then we get to the seed stage, and maybe they've found their initial team or their co-founder, and they've gone to work starting to build the product, and they're building multiple prototypes and testing those, and maybe they're even making some kind of pilot or demo sales and then coming back to the drawing board and reiterating. But usually they're still in the pre-revenue phase. At Series A, that's when product is built. It can always improve, but there is someone out there who is willing to pay good money in order to get that product or service. And they've already been able to show that initial traction. And then the priority just becomes, how do we scale this thing and further develop it and enter new geographies or product areas? And then that maturity just continues into the Series B, C, D. With each round, the valuation grows, the amount of financing that goes into the company grows, the risk decreases, but then the return kind of potential also changes. There's kind of trade-offs at playing in different parts of it, and there's also very different types of VCs that are best fit for different kinds. At the pre-seed, it's really about the founder, and you have to have a really good gut feeling about this is going to be the person to really make this idea become a thing. But at Series A, you might have a lot more analytics involved. You're looking at previous traction. When you get to Series B, C, it just becomes more of that. There's slightly different types of investors that kind of play along the different stages.
Exactly. And like for angel investors, when they're really early, they're investing typically in the pre-seed stage or seed stage where the founder plays a bigger role and there's like really little or no data as to the traction, etc. There you would require a much bigger return actually than the 3x that you get on the later stages, right?
Not necessarily. VC overall targets the kind of 25% returns, IRR, or about 3x the money. The difference with the kind of required returns at the higher risk pre-seed stage versus the Series A is that at pre-seed, they're smaller tickets. You will make more bets in general. You could make 40 bets, and then the vast majority of them will fail. Most startups do. But then the idea is that if you came in when that company was valued at $1 million and then you sell it for 40, that's a fantastic return. Even if every other company fails, that's way more than 3xing. When you come in at Series A, if that company is already at 40 million, it just means you have to get to even higher kind of exit valuation. The returns potential at pre-seed is higher, but the risk is so much higher. So in the end, the return averages across the different areas about equal the same.
Good to know. And last but not least, do you have any advice for women who want to start doing impact investing or who are founders in the impact space?
Yes, I think we even touched on this a little bit earlier. You talked about the power of networking. Women can do anything. I think women are so fantastic. And anything is achievable as long as you just go about it. It's going to be a long list of to-dos. It's going to be setting up, I think I took over 100 coffee chats when I was trying to move to Stockholm, like setting up the video calls. And then we have to put the hours into prepping for the interviews and having the technical skills. And it's a long laundry list of things to do. But I made my way down it and it worked. I really believe just if you want to do it, just get out there and start on the list. Once you're there, I think the most powerful thing, if you are an investor, find someone within your organization to champion you and fight for you. Find someone outside of your organization to mentor you, teach you. And if you're a founder, same exact thing. Look for people in your ecosystem who are good at what they do in your industry or not, and constantly seek to build that relationship and gain learnings from them. Once you progress, be that advocate for others. I try to go out of my way whenever we reject a female-founded startup that I've taken time to really speak with. I always try to go out of my way to call her and say, I want to give you every bit of transparency on why this ended up being a no so that you're better prepared going into the next investor meeting. And if you solve these things, then let's talk again. We have to do that little extra bit of work to uplift women in the space. And it's such a heavily male-dominated industry, but I don't think it needs to be. So yeah, I think it's just get started, going down the list. You are so capable in everything. And when you get there, look for your advocates who will lift you up And if you're listening to this, call me. Like,
Wonderful.
it's a relief. I've met a fantastic ecosystem of women in this space. They're super inspiring and empowering. So yeah, we have to lean on each other.
Exactly. You can find Chloe Fu on LinkedIn.
Check me out.
Fantastic. What a great way to end this conversation. Thank you so much for joining.
Yes, and thank you so much for having me.
The information provided on this podcast is for informational purposes only and should not be considered investment advice. The opinions expressed on this podcast are as of the day of the recording and are subject to change without notice. The views and opinions of guests on this podcast are not necessarily those of Finance Latte AB or its host Margarita Tr, collectively referred to as Finance Latte. Finance Latte is not affiliated with its guests or their affiliates unless otherwise stated. Finance Latte does not guarantee the accuracy or the completeness of the data presented herein. The information on this podcast is for informational purposes only, and the information, data, analysis, and opinions it includes should not be considered investment advice or tax advice, and is therefore not an offer to buy or sell a security. Finance Latte AB is not responsible for damages or other losses resulting from or related to the information, data, analysis, or opinions in the recording. Past performance does not guarantee future results. All investments are subject to investment risk, including loss of principal. Individuals should consider their own unique needs and circumstances and objectives before making investment decisions. Please consult with a tax or financial advisor for advice specific to your individual circumstances.